Yo, 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 what's going on, guys? It's your boy Chicker2 Invest bringing you back with another freaking YouTube video. Yes, sir, yes, sir. Look, man, first thing first, I'm gonna just start off by saying I am a retail investor. I only make 44K a year. So, if you want to follow my advice on dividend stocks and picking dividend stocks, just know that I do my research, I do my due diligence, I read books about dividend stocks, etc., etc. So just know that the stocks that I provide here, they have good fundamentals, they have good balance sheets. So I really wouldn't recommend a stock to y'all if it's not a good stock. You know what I mean? Like, I'm not that type of person. But at the same time, if you do buy a stock that I recommend, just buy and hold it, man. Because there's of course times where the stock has like a 5% pullback, 10% pullback, or it's just going down for 7 days straight. Look, man, just always buy the dip, never sell. Because look, I'm gonna tell you right now, man. There's a couple times where Texas Roadhouse, it's one of the stocks that I am gonna recommend to y'all in a bit. It hit $90, and then from $90 it stopped right there, and it went straight to 130 after a week or two. So, like I said, man, if the stock has good balance sheets and you do your own research, then what is the point of selling the stock? You know what I mean? Like, you do your research, then have confidence in your research. So I'm gonna show you right now, guys, the first stock that I recommend for y'all to put in your stock portfolio, or sorry, dividend portfolio. First thing first is Texas motherfucking Roadhouse. And I'm gonna tell you guys right now, if y'all ever went to Texas Roadhouse, man, y'all know Roadhouse is always freaking packed. And I mean it's packed. And that's good, at least, because that means that the company is making good money. And then also is one of the highest paying stock in my stock portfolio. 24% profit in my stock portfolio, which is $215. And y'all think I'm lying about the stock hitting $90? Man, I bought it right here at 110, and it dropped all the way to $90. And it was the worst, man. I was like, bro, I was sad. I was like, I need to sell. I'm gonna lose profits, but I hold, and I did diamond hands, and I stick with my confidence by keeping this stock. And guys, I'm gonna tell you right now, man, I hope this changes y'all's mind on putting these in y'all's stock portfolios. But look, man, first thing first, we go to the Qualtrim app, which I do recommend for investors to look at the balance sheets, because this is just much simpler and much easier. So first thing first, man, like I said, I love Roadhouse for many reasons. It has constant revenue growth. It's just year over year growing, and is not stopping, is not going up and just steady, steady, steady. No, this is constant growth year over year. The free cash flow is not the best, but to me, as long as the cash flow is on the positive side, that's all I care about. To me, it doesn't really matter to me as much, because as long as the cash flow is positive, then that's all that matters. And then of course, when you see a negative cash flow, make sure you do your research on why that cash flow on that year was negative. And right here it says 2020, and we all know what happened in 2020, man. COVID happened, and of course many companies got impacted by COVID. So that's why on 2020 this company was on the negative cash flow. And then also, Roadhouse has good net income, which is pretty freaking amazing. And once again, 2020, they got impacted by COVID. Look at this. Net income. Constant, consistent growth. With good net income, guys, they can use that money to pay off their debts. They can increase their dividends. They can do buybacks, et cetera, et cetera. That you can think of that is good for the stock. That brings the stock back up in price. So the net income also matters for a company, which is good. And then, of course, you always want a company that has more cash than debt. And like I said, it's not bad that a company has debt, but just make sure that the company can pay off that debt 3 years ahead of time with their net income. So, for example, their net income for Roadhouse for this year was 63 million, right? So let's say, for example, Roadhouse had 190 million right here. So if that company can pay off that debt with the net income 3 years from now, then that means that they can pay off their debt whenever they want. It's just up to them. It's just up to the company to pay off their debt. So basically, Roadhouse has zero debt. So, that's good. And then, of course, guys, the dividends. When you pick a dividend stock, man, make sure that the portfolio increases 12% year over year. And right here, Roadhouse increased 90% year over year, which is pretty freaking amazing. But all right, guys, look, we moving on to the second stock pick. All right, guys, the second stock pick that I truly like and I recommend to people is Valero. Valero is one of the best stocks, best energy stocks in my opinion compared to Exxon. And if I'm being completely honest, people just like Exxon because of Warren Buffett. So the people that like Exxon are the people that basically ask other people, what do I do with my money? Where do I put my money at? What's a good stock to buy? And of course they follow Warren Buffett. He likes Exxon, so of course they follow his steps. And I'm gonna tell you guys right now, in my opinion, I think Valero has a better opportunity than Exxon, in my opinion. And then of course right here, 11% gain, $131 in my stock portfolio because I bought this at the dip. Once again, Valero has good revenue. Look at that. Constant revenue growth. Well, it's not that bad, but at the same time, it's still pretty good in my opinion. Good free cash flow. It's all positive. So that's really good to me. The net income, oh my God, right here. Like I told y'all guys, the net income is what makes a company great, makes a company amazing. So make sure you look at that net income and that free cash flow, revenue, the dividends, and the cash and debt. More cash than debt. Valero has zero debt, and they have $5 billion cash in their bank, which is freaking amazing. The dividends, it increases year over year, which is really good. And then me personally, man, I don't really expect Valero to increase their dividends, but if they do, that's huge because they are already paying a high percentage amount of dividend, which is really freaking good. For one share, guys, you get back $1.07, which is really good. And they recently just increased this dividend actually. And then of course the payout ratio is under 50%, which is really freaking good. And also the PE ratio, I think is 10 if I recall. Let me actually go back. Let me go back. The PE ratio right here, guys, 5. Bro, that's good. And then look, pending dividend, almost $10, bro, for 9 shares. And it's gonna be the one and only JP Morgan Chase. And I'm gonna tell you right now, this probably might be one of my favorite stocks in my opinion. I truly love JP Mortgage. I wish I can buy more, but the thing is, man, with JP Mortgage, this thing is just on an uphill every single day. There's no freaking dip. I want this stock to go under my average cost, because one thing that I'm learning as a dividend investor is to buy a stock that's under your average cost. Never buy a stock that's above your average cost, because you want this to go lower and not higher. So I'm trying to be more disciplined on that. I mean, of course, it's not as much market value as I wish it was, but I can't really complain about it. It's still making me some money. It's making me profits, which is really freaking good. And now time for the balance sheet on why this stock pick is my favorite. Once again, guys, the revenue, man. JP Morgan has really good and impressive revenue growth. The free cash flow is not the best, but at the same time, I don't really judge a company based off having one bad metric. As long as all 4 or 5 other metrics are good, then that's all that matters to me. So basically, if the stock has 4 good metrics and 1 bad metric, which is the cash flow, I still think it's a good stock because it makes up with the other good metrics in that balance sheet. Now, also the net income is freaking good, man. The net income is also freaking good. Steady, consistent growth. And then, of course, guys, the cash and debt. And yes, I know this has more debt than cash, but at the same time, like I told you before, if the cash can pay off the debt 3 years ahead of its time, then basically this is debt free and they can pay off their debt whenever they want. So, like I said, just multiply the cash by 3 times, and then if it cannot pay off their debt for that company, then I do not recommend buying. And then of course the dividend increase is really freaking good. It's growing year over year, and recently we got a 5 cent increase, which is really freaking good. And in my opinion, this is probably one of the best banking stocks in my opinion. And of course, the payout ratio is under 50%. The PE ratio, let me check, it is under 11% or 11, which is really good. And then, guys, also, of course, Chase has good earnings, in my opinion. They came out with recent earnings not too long ago, and they just blew my mind. They build out small companies for banks, and I'm just like, bro, that's crazy how Chase has this amount of money. So, guys, that's it for the video, guys. I hope y'all like and subscribe. I'm trying to grow the channel. Much love. Take care, and I'll see y'all next time, guys. Peace.